The Treasury Department is assuring customers of two failed banks that they will have access to their money today. They're also promising that the rescue did not come at the expense of the American taxpayer. Dale Hurd has the story.
Banking regulators took action after damage from the second biggest bank failure in U.S. history began to create a panic and rippled around the world. After the failure of Silicon Valley Bank and then Signature Bank of New York, which invested in cryptocurrencies, regulators are now promising depositors they will have access to all their funds when branches open today.
I think that without this, there could have been some serious runs on other banks because there would have been a loss of confidence throughout the whole system.
The turmoil began last Wednesday when Silicon Valley Bank, a major lender in the troubled tech industry, tried to sell assets to boost its balance sheet after losing money in bond investments when the Fed raised interest rates. That panicked investors as customers raced to withdraw funds after seeing the news on social media. The Fed stepped in, tying up $150 billion in deposits and putting some banks and tech companies at risk. Treasury Secretary Janet Yellen says the emergency measures put in place are not a bailout because the funds will come from an FDIC account, a pool of money paid into by U.S. banks.
We are concerned about depositors and are focused on trying to meet their needs.
And while depositors at the banks will be protected, stock and bond holders will not be. The crisis had already spread to Britain, where Silicon Valley Bank had a subsidiary. The government and the Bank of England facilitated the sale of Silicon Valley Bank UK to HSBC for £1 and ensured the security of deposits. Dale Hurd, CBN News.
Well, on Friday, I told you to pay attention to this California bank, that it was getting to be in trouble. And the problem was that they had all these government bonds, and on their balance sheet, they were having the government bonds decline in value because the Federal Reserve had raised interest rates. And so they had to rebalance in order to come into the guidelines from the same federal government that raised the rates. So in order to maintain their status, they had to come up with $2 billion in additional capital. They were unable to do that. And literally in the space of hours, I was saying it at 9 a.m., and by noon that day, $40 billion had flowed out of that bank. And here comes the FDIC to shut them down. That's the precarious nature of our current world economy. This isn't just the U.S. This is happening around the world as banks are coming into trouble because of their balance sheets. And it's just sort of natural economics. If the Federal Reserve raises interest rates on bonds, then the value of your existing bonds goes down. And you have to then sell them at a loss and get new bonds. And it's just a sort of a spiral effect. If the federal government doesn't come in and say, we're going to back up every depositor, and then all of us are going to get nervous. But what does that do? Well, it creates worldwide panic. I would expect the stock market to be really shaky today until we can come to some kind of stability, find a buyer for this failed bank, and then figure out what to do with all the depositors. But it just shows how one bank can really upset the entire system. You go back to 2008, and it was Lehman Brothers. It was one of the largest in the world. And it affected money markets. And when it did that, our sitting president, President Bush, said, this whole system can come down. We were supposed to be past that. We were supposed to have all these reserves, all these protections in place. And here it is happening.